Good morning, everyone. I am CA Shruti Gupta, moderator for 37th Valuation Manthan session, Valuation of Customer Intangible Asset and AWF, organized by the Valuation Standard Board of ICAI. We are delighted to welcome you all to an empowering journey through valuation expertise. So, without any delay, I would like to welcome the speaker for the day, CA Rajiv Singh ji, a renowned expert on valuation. Sir's expertise lies in banking, governance, corporate finance and strategy, M&A and restructuring, risk management and internal controls. Over the past 27 years, he has served over 400 valuation clients in India, USA, UK, Singapore, Hong Kong, China, Belgium, Mauritius, Nepal, Dubai, and Africa. Sir has been retained and testified as an expert witness in India and abroad, including the London Court of International Arbitration and ITAT in leading valuation cases relating to economic damages, transfer pricing, and transactional disputes. Sir is a certified information system auditor and a registered valuer with IBBI. He qualified independent directors exam conducted by the Indian Institute of Corporate Affairs in 2020. Sir is an adjunct faculty and the course director of the valuation courses run by IICA, which is a flagship course that has earned the distinction of gold standard in valuation education. He is an adjunct faculty of IIM Jammu for the valuation course and is the head of SFA Valuation Standard Advisory Board of IOV RVO, which is the largest RVO in India. Sir has presented, instructed, and written on valuation, banking, and corporate finance topics. He has been a speaker in over 1,000 seminars and training programs on valuation, banking, and finance related topics at different professional and industry platforms, including IIM Bangalore, SBI, UBI, ICAI, ICSI, IICA, ICAN, IIT Roorkee, IIT Delhi, PhD chambers, and other similar forums. Since 2008, he has trained over 10,000 chartered accountants, company secretaries, MBAs in India and Nepal. Thank you so much, sir, for gracing us with your presence. Sir, with such vast experience that you have and with your knowledge, we are sure that in next 2 hours, you will share with us immense insights and we are all eager to learn from you. Over to you, sir.
Thank you, Shruti. Good morning to all those who are hooked to the program today, morning on Sunday, holiday. I must first salute all of you for taking time off from your very, family times and etc. This topic which I'm going to address today is a very important from business point of view and also from valuation point of view. So therefore, it's a pretty complex, but I'll try to simplify as much as possible so that you can comprehend and understand the gamut of that. So we have two important topics. One is customer-related assets valuation, and the second, the forming part of that is assembled workforce valuation. So why it is necessary and important. Okay. So before I give you a structural way of learning in next 2 hour session, the most important thing I'd like to first address 2 minutes on assembled workforce importance, and then we can come back for customer related intangible assets valuation.
Excuse me, sir.
Yeah.
I'm so sorry to interrupt you in between. Can you adjust your camera a little? Your face is not visible.
Is it okay now?
Thoda sa aur.
Okay.
Sir, can you do it a little bit more?
Is that fine?
Yes, it's better now. Thank you.
So what we are going to do is understand first assembled workforce importance. So just to give an example, suppose you buy a business and you buy everything. You buy fixed assets, you buy, operating facilities, you buy everything in the business. But what if you don't buy the people? So whether you will be interested in buying the business? Mostly the answer will be no. If it is a running business, because you need skilled people in the business. So, so therefore, when you do a business acquisition, assembled workforce, which is nothing but skilled employees or unskilled employees both together, which are major contributor. In fact, today's world, people are the most important asset. Apart from what we discuss about technology and other aspects. So you pay for this, but the problem with this that there is economic value we pay for a transaction is done. Unfortunately, in accounting world, if you refer IS 38 or Ind AS 38, these uh, this particular intangible assets like assembled workforce will not be recognized in the balance sheet. On the balance sheet, why? Because if you refer the recognition criteria, uh, on assembled workforce, typically you do not have in a routine company, you do not have a control over that. That's the basic definition of asset, that you have to have a control over that. So you don't recognize such assembled workforce on the financial statement. We still do a valuation of that. Why? Because when we do a valuation of other intangible assets, and this is a major, kind of a asset which is being used, so we charge something called economic rent over that. So that's the one major objective of valuation of assembled workforces. Because without that, you'll be overvaluing because you would not be giving a proper treatment for those assembled. So it's like a rental. So how we exactly value and what is the purpose, once you know that, then you know exactly the overall methodology and then the process which will explain later on. So let's first understand I'll first touch upon the complicated portion. And assembled workforce is pretty easy in a sense that it is mostly valued by, there are some critical issue which I'll highlight at the end. And the complexity is more in other customer intangible assets, and those are very important in some businesses. In some businesses it can have a secondary level weighting. So let's first start. I'm just sharing the screen so that you have that understanding, and we can move for customer intangible assets one by one. I hope it is visible to you. Okay, that's done. So,
Sir, it is not in the PPT mode.
not in PPT?
The PPT is visible, but it is not in the slideshow mode.
Okay, so should I put in slides now?
Yes, sir.
Is
Yep.
it okay now?
Yes, thank you.
So this is the topic which we are addressing, and uh, the takeaway for today's session for 2 hours is first understanding what are those typical assets which we can call it as a customer related asset. Then, of course, how we'll approach that particular valuation if I identify the assets, because uh, before we move forward, we need to understand that we have intangibles which are of the nature which are identifiable, covered by index. There are intangibles which are unidentifiable, but still they are intangible, covered by separate accounting standards, Index 103 or IFRS 3. That is your goodwill. So goodwill is an intangible asset but unidentifiable. So it is a residual figure, right? And covered by a separate accounting standard. So we are discussing customer related assets which would be identifiable in on your financial statements, covered by Ind AS 38, and then we'll approach. So it is not only, I repeat, the valuation of customer intangible asset is not only for accounting purpose compliances. There are a lot of transactional thing happening. And one critical thing which is happening is called contract monetization. So if you have a serious contract which are more visible and less risky, so you can monetize the contract in a sense that you can give that contract as a security, okay, and then raise money on the international platform. Not happening in India, but mostly it is expected that in maybe another 1 or 2 years you will see this situation happening. And then third is the transactional part. Fourth is your transfer pricing situation. So if I have my customer contract in US, my tax system will be different. Maybe I'll be paying around 35-40%, versus if my uh, the customer contracts are in Mauritius, the tax rate will be pretty low. So those kind of a structural part happens, and then you'll have a various multiple use of this valuation process. And in this, there was a special topic of assembled workforce. So let's first understand, uh, when we talk about customer related intangible assets or customer contract is one of the component. There are a number of component which comes as a part of the customer related intangible asset. One segment of that we call technically as a informational element. Okay, so what this informational element would be, is knowing the name, address, telephone, email, customer account, credit card, all those details which would be available to an entity. To what extent it is valuable, to what extent it can be recognized, when should we recognize, when we should not recognize. Based on that, the valuation process will move. Okay, and then we have an expectational element of that, which is very important because this is what the income portion of the valuation is. I mean, if you have the data and if you cannot monetize it, so there is no expectational element involved into this. One classical example, which I later on also say, because of now very tough, I would say, data protection law across the globe coming up. A lot of information which you collect, you legally will be prohibited uh, from selling those information in a exchange, in a market, and as a result, those will not be recognized and cannot have a value. So only where it is possible to monetize it and it is legally transactable, there is what your valuation will come up. So remember, this is a very broader introduction of topic called customer related assets. So one part is about information, another part is your expectational. uh, then we'll try to see, uh, initial my topic was a customer list, and I'll show you that how small this topic is. It appears for a lot of people who are in business now that the customer list or information is a very critical asset. Some businesses maybe, but what level it would be like, you may have a customer relationship with B2C business, you may have a customer relationship with B2B business. So where that customer relation list per se theoretically would be your customer related asset. That will depend upon facts and circumstances, but I'll summarize later on. Also, I'm just introducing at this stage. Typically, if you have a B2B customers, they are eligible for inclusion as a part of your customer intangible. But if it is a B2C, in a very rare circumstance with a very high end of a proof, such customer relationship will be recognized. So one has to be very careful when we are looking at all these angles. Apart from legal part and contractual, you also look at the economic part of that. Okay, so this is what a customer base includes. A customer base includes customer list, customer account information, and then likely expected future outcome from those information. Based on that, I will select the valuation approach, right? Conceptually, the valuation approach should be dependent upon to what extent I'll be able to, get revenue or income from or economic benefit from such asset. Okay. Uh, Also remember that such assets are basically wasting in nature, in a sense that because of the competition, growth, and other industry factors, technical obsolescence, etc. This the one which you are saying right now, net set will be adjusted over certain time. So very few situations will find they have a life more than 10-15 years. I'm not saying they are not exceptions, but these are some general. Yeah, is there an issue? Here's some background. Okay. So this is a list prepared for you. One is the pure customer list. One is with a customer database, which is a more expanded version of the list. So in list, you have a very limited number of information. In a database, you'll have a more detailed information. It could have a pattern of buying pattern of customers. It can have customer behavioral pattern. So a lot of stuff would be there in the database, and that's what we broader will have a conceptually will have a higher value than just a customer list. Okay, so whether we'll go for how we will approach this depends upon what is the facts before us. Then in construction industry and some other industries also, you have orders which you aid to execute. Some portion you have done that. So on the valuation date, you might have certain open purchase order, which we call as a order backlog, which means some work is still to be done. Out of all, when you do evaluation, also understand the risk portion of that, and a backlog order will have a lowest level of risk. So when we do valuation of any intangible asset, principally the concept is that weighted average cost to capital or WACC, which is an average basis risk consideration and a compensation for that. Your intangible assets are considered riskier than weighted average risk of an entity, and as a result, ideally, my intangible assets, depending upon the risk of that, should lie between WACC and cost of equity. Some of them can be even close to even higher than the cost equity, depending upon what kind of intangible assets we are thinking of. Okay, so the cost of equity or cost or WACC, whichever will apply, will depend upon the riskiness of that. So, for instance, order backlog might be, I repeat, might be uh, very close to WACC in terms of riskiness. So, therefore, you might be preferring to use WACC only rather than using any additional part of that. There is no standard methodological thing available which will give you that this is the way to work out cost of capital for intangible asset. It is based on conceptual point, and the conceptual point is that it has to be higher than riskier. So you can start with the order backlog, which is the lowest risk in the consideration, and based on that you can move forward depending upon, are you talking for patent, trademark, trade name, trade dress, you are talking for uh, trade secret, each kind of our customer intangible asset which we are talking about. Of course, this also depends upon whether it is B2B, B2C. B2C would be pretty risky and very difficult situations. So you need more additional proof to justify that. The last two category which I'm discussing is there could be a many variant of that. Okay, so one is called customer contract, which probably for all people who are there, not involved in valuation can easily understand these two part of that, but this is also complicated. Uh, and that's what I say. Identification of asset is very important. Understanding of what type of intangible assets we are valuing, and understanding of that in terms of economic benefit is going to help you in deciding the methodology and the process. Of course, there are settled technique, uh, and there are still emerging technique in terms of doing valuation of this, because these are pretty, I would say, complicated asset, but very valuable and critical assets for any organization. Okay, so the customer contract, when we talk about that, means you have something in writing, right? A legal, a contractual relationship exists between your between the company and the customer. So that's the customer contract. It may have a contractual life. Okay. Now we have a customer relationship. So now customer relationship can be contractual and customer relationship can be non-contractual also. So this is very important. So when we do a valuation of a customer contract, what should be my life, that is technically called RUL, that is a remaining useful life, that will depends upon your analysis of the customer contract, the competitive position, the past relationship, technological development, options available to the users, etc. I'll show you some of the factors which we use in real life situations, which are very critical to decide in any intangible assets valuation. First is to understand the asset, then is to understand the economic benefit, and the most critical part after that is to understand the time up to which we are going to cover for the valuation. So, in contrast with your normal DCA valuation for companies, where you go and apply terminal value invariably, in some cases you may not be, but here deciding remaining useful life is a very critical consideration. Sometimes it could be a quantitative or qualitative analysis, a mix of both, depends upon the fact. And that after that is last is the discount rate. If you're using cash flow approach, as we all know that mostly all intangibles, including these, will be valued using income approach. Some of them would be valued using market approach, and some of them can also be used valued based on your cost approach. Like assembled workforce is one example, and why it is done I'll also explain when we go back onto this. So everything is logical. So we may have a situation where a customer relationship is flowing out of contract, and that could be a pretty debatable issue, and requires a lot of adjustments. In a sense, more risk is there in terms of renewal. In that situation, your discount rate for renewal cash flow can be different from the cash flow for the contractual period. Are you getting my point? So there could be a probability of renewal involved, and there is also a higher risk involved in getting economic benefit out of that renewal episode. So a customer contract which looks like should only be valued up to the contractual or legal life, what we call, may not be true if you have a expectational element. I think when I open up, you must have seen that element which was very clear, expectational element, which is nothing but the renewal chances. So how do we do that? Is what I explained. So you look at historical relationship, you look at the the basically the purchaser's positioning, seller's positioning, the technology involved, and your dependence, emerging technology, market. So many factors comes in while assessing renewal portion of customer contract. In some certain purpose of valuation, for instance, if you are doing for transfer pricing purposes, it may be possible. It is a maybe a requirement that you should only close your valuation up to the legal remaining useful life. And sometimes your legal contractual life also can decline depending upon the market condition. So depending upon the purpose, all factors will be very relevant for deciding remaining useful life. So this is the one aspect. Customer relationship, which is flowing from customer relationship. So you call this as a customer contract and relationship, or customer relationship and customer contract. So depending upon what is more important, there could be certain uh, situations where we'll be valuing customer relationship, and that's how a lot of people questions, right? That if there is no contractual relationships, on what basis we are calling this as an asset? This would be called an asset based on separability criteria, which I'll show you later on. There are instances, and is happening across the globe, when we have a non-contractual relationship customer also, they are being transacted, and there is a price involved for that in separate. So therefore, they meet the separability criteria. But within the customer relationship, is it part of the customer contract? So when you go for a renewal portion of a customer contract to be counted while valuing a customer contract, which means you are talking about customer contract and customer relationship from contractual relationship. And when you have only no contractual, no legal, uh, con- uh, you know, document available, and still customers are there and buy sale is happening, that is your customer relationship. That's what called non-contractual customer relationship. So I'll give you the definitional part so that you can now understand that, and based on that, we'll think about how do we move for deciding approaches, methods, so that we can quantify them, right? So you can see it here. Uh, all customer list, generally, if it is arising from contractual, kind of a relationship, so typically they meet. But as it is shown here, walk-in customers. So walk-in customer is, we are talking about now B2C, right? They just come by and go. So looks like, are they valuable for us? Answer is yes. For a lot of online companies, this concept will be very important. Do they meet the contractual, legal, or separability criteria? That's the important thing for you to guess at this stage. Whatever I've given you, anybody can answer that? Does that meet the contractual, legal, or separability criteria? Okay, so typically the answer for this would be no, because they're a B2C customers, right? And they mostly, it is considered that they would be flocking to your center, not because of this customer intangible assets is so important. There's something else. Some of the intangible assets would be critical, like trademark or trade name. So, those aspects are very important. For instance, take example of McDonald's. So if you see the M, that's the trademark of McDonald's, and then you folk in the store and you enjoy the food. Okay, so the trademark and other aspects of the primary, intangibles there. Customer who are walking in, will not be then meeting the separability criteria, because it is all walk-in is linked with the strong trademark or some other intangibles of a company. In some cases, it could be technology. In some cases, it could be uh, your patent of the technology, which could be relevant. So this is a customer list also, as I said, is not so easy. When we are expanding customer list to a broader version, it becomes a customer base. And in case of situations where we are talking about only walk-in customers, so generally they are not separately recognized. They become part of, when you do valuation for trademark and others, effectively they are covered there and separate. They do not exist. So that's the point which we should understand at this stage, right? Next, this I have already explained, that what the customer contract is. Now I'll give you the definitional part of customer relationship, which is very important for us to comprehend, because customer contract would be easier. In fact, in the contract, there are a lot of legal aspects. So well, I appreciate that when you want to do a valuation of a customer contract related intangible asset, you're not only focusing on customer contract related intangible asset, we should also be in a position to understand the other type of assets which would be needed to support the cash flow. Okay, and therefore understanding of other intangible assets would also be very important. So if you are not able to comprehend that which are the other intangibles necessary to bring customer, okay, which are the other tangible and intangible assets which would be necessary for generating the cash flow, you will not be in a position to value customer contract or customer relationship, because no intangible, including customer contract, irrespective of how important they would be, can generate cash flow in isolation. You need to have support, and those support assets need to be valued. And therefore, you need to have kind of an economic rent, which we'll discuss with the method which we'll use for that. How we scrub out, how you get, cash flow, which we can say it is attributable to a particular intangible asset, is a process which you adopt and then do a valuation for. So let's first see what the customer relationship definition is. And this definition of customer related asset is issued by Appraisal Foundation of US. In my understanding, it's one of the best definitions for you to know, and and then try to understand that when we are confronted with a life situation, analysis of relationship is very important. It's not so simple and pure now like other valuation exercise. Like if you go for tangible, this is the building, this is the area, etc. Here, whether it is an asset or not itself is a big question. And so therefore a lot of analysis would be needed. What it says that a relationship that exists between an entity and its customer, if entity has information about the customer and has regular contact with the customer, and the customer can make direct contact with the entity. This is very important. Sometimes it is quite possible that the customer has no way to go directly to the to the entity, and it happens in case of number of institutional, because of now we know that there are a lot of technology. Take example of banks. So the fintech company, there are two kind of situation can happen. One, where they sits in the programs and software or database of a bank, and banks does everything. So it is your technology, and you just rent this technology, you charge for rental, and bank uses, and the customers directly interacts with the bank. In some other cases, the customer may not be knowing anything about who is the entity. So take a customer for housing loan taken by Policy Bazaar, and say HDFC, SBI, or Union Bank of India is financing it. So customer cannot go and directly connect them. So you have it here, and Policy Bazaar have it. In fact, all fintech company where they are onboarding. So who onboards? If they are onboarding customer, and in turn they are allowing other people to do transaction part. I'm not saying that when the transaction is entered into, which means that when the loan is given, the bank will not know. I'm talking about situations where the customers are being onboarded, and at the stage of onboarding, whether they are in a position to make a direct contact with the entity or not on a regular basis. So they have a large set of database. Those who have got the loan from a bank, that becomes then the customer relationship a bank. But those who just tried, and somehow the loan was, or attractiveness of that product or facility was not good enough, that remains with the fintech or any support organization who onboards it. So they have a massive database to manipulate and then direct the customer base. What I'm trying to say is that in future, because they onboard, not the bank, so those assets should be them. The customers can be diverted to anybody who then will have a relationship with that onboarding company. So this is a very important when we look at customer relationship, and based on that, we will discuss about B2B and B2C customers, which will be important for understanding. The question here again arising from this, as I explained earlier, a relationship can be of a contractual basis. As I explained earlier, it is viewed in a different perspective because you have a contractual relationship going, and then based on that, you have expectational element, and that expectational element is of a renewal. But is that the non-contractual relationship is separable? Answer is yes, which we all know. This situation can also be, especially we are talking here B2B, because those customers are, even though there is no contractual relationship, but they are in a different footing as compared to customers which are at B2C level. So this would be valued, as the other one would not be valued. Here is what I summarize. So when you have a B2C customers, a classical example is walk-in customers. So they don't meet the recognition criteria mentioned. There are three important recognition criteria under Ind AS 38. Okay. Uh, and one additional criteria is definition of asset, that is whether entity have the control over that asset or not. So AWF gets out because of the additional criteria which is flowing from the definition of asset. Otherwise, you have a three important factors under Ind AS 38: identifiability. Then you have non-monetary asset character, and then third is about your that there should not be a physical substance. And within that, identifiability is critical. So it should be either separable or it should have a contractual or legal relationship kind of situations. We are now discussing in customer context the same principle, that can it be a situation where B2C customers can be considered as a customer relationship thing, because there is no contractual. These are the customers who are just coming in and buying your product on a regular basis. So all online kind of a platform where you're directly dealing with the customers. We still, for layman, it appears that these are serious asset, but will they literally meet the definition is what we are saying. I'm saying generally do not. That means in a very special situation, if you will be able to justify the economic benefit and how long they are going to sustain. There are some other aspects which we'll see how you go and identify that each customers would be generating cash flow for the organization for so many years, and what would be the frequency. All those aspects will be pretty critical. So that's the reason why at consumers level, it's very difficult to identify. So, I mean, one would be wondering where it goes then. I mean, I need to pay for such kind of a consumers? Do I need, suppose somebody says that I have got a online platform and I've got so many, people buying, selling, on consumer level. So if some other person wants to buy a business, do I need to pay for that? Answer is yes. If there's economic value, only remains that all those aspects will form part of goodwill. Okay, it will not be a separate intangible assets, a customer related intangible assets. Your goodwill will be higher because you need to pay. There's no doubt about that. If somebody has developed a business and develop a customer base, because that customer base might not have contractual relationship. They might have come once or twice to your platform, but they can still come back, or they can also refer to other person, and therefore you have a business coming in future. It's pretty difficult to predict, and that's the reason why here it generally do not meet the criteria of separability. And but B2B typically will have a relationship, and they would be considered because these relationships are more developed, and the customers, their background, you can identify because it's a business to business. So such customers, of course, I'm not saying all, depends upon how deep that relationship is, what is the business volume from that, I mean, all kind of analysis will come. We are only discussing here or generic. So fact wise, here also some customers may not meet that criteria which we are looking for. Okay. The principles of valuation here, as I said, when you have this customer contract and relationship, it cannot be valued either based on the cost approach. So, I mean, once you make an analysis, that's how we started with, and I'm re-emphasizing this point. Once you understand the asset properly, it is much easier for you to develop a proper methodology. All standards, whether you talk about ICI valuation standard or IBS or any standard, they are nothing but accumulation of best practices. Okay, so they will be talking the same thing. So either you read them and come back, or you do a reverse one. You read, understand, think that this should be, and then check what is written there. Is much better way to look into those situations. So you can't do a cost approach here because the cost approach difficult to find out the cost of development. Even if you are able to find out, this will not truly reflect the economic value of such relationship because they are critical assets for sustaining my top line, which is a pretty critical exercise for any company. So cost approach is ruled out. The market approach, unless you are in a similar business, and customers are pretty unique. Even if you're in a similar business, your processes, your trademark, your so many other assets could be a vital component which would be critical for generating overall revenue, because there is no component wise revenue. Are you getting my point? So even in a very comparable business, there could be a number of differing, there could be number of issues which are critical to a particular business, and therefore even if there is a transactions available, though it will be very limited, two problem will happen. It will might not be available for close to your valuation date. So if it is not available close to the valuation date, so even if the transaction data is there, it will have a very you know very less relevance in most of the situation, because your economic condition, market condition would have changed by the time you are looking at those numbers. And the most important issue based on which they gets rejected is your comparability, because there is no way for as a valuer for you to understand that what was the major critical factor which was the driving force for that particular customer. So if that is not known, is pretty difficult. So in the absence of this, what we left out is income approach. Okay, and within the income approach, as in any kind of asset, the conceptual point is very simple, that when you try to value customer relationship or customer contract, which we have seen that, or maybe a backlog order, which is one of the most easiest and most close to certain kind of cash flow. I'm not saying 100% certain, but it's more less probability or less uncertainty involved in the cash flow, because you have a customer and you have done some portion of the job, so balance portion of the job has to be done. So risk is average risk of a company. So that's the best visible cash flow. In this all other cases, uncertainty will be higher, and then you will agree with me, in that situation your discount rate or cash flow must be adjusting for addressing those higher uncertainty. Then there are other two important features which I wanted to discuss here. Uh, Typically, when you do valuation, you look for some high value customer relationship. So I'll go, and when I go and discuss further, a company total customer base is classified in homogeneous and non-homogeneous, because that also will be a critical factor for deciding the valuation methodology. When I say homogeneous, means similar kind of a profit, similar kind of geography kind of. So depending upon the case, you find out that these kind of customers can be clubbed together. So those becomes, because sometimes individual level also, I'm talking not for B2C, I'm talking about B2B. You may have a situation where out of say 100 customer, you can club them in 4 or 5, and those would be group subgroup within total as a homogeneous. So it will be easier for you to roll valuation methodology and club them together. So there is another very interesting feature, and if that happens, that is an indication of higher value. And that is, if you have a high value customer. So when I say high value customer, means we are talking about where you have a substantial portion of your business is dependent upon such customers. So therefore, obviously, the relationship will be of different footing. And if the market analysis supports you, that their dependency is necessary, because sometimes I give an example. When I was doing for a company which is based in Noida, it does printing and other kind of a contractual job across the globe of various publishing house, all big accounting firms, so many other people in terms of preparation of their document, uh, and publishing stuff. It was pretty difficult. I'm not saying that there's no competition, but it was pretty difficult for a deeply involved customer to migrate. So be clear on this important point. If you make a analysis, and most of them will come from reading your management discussion report, conference calls, because that is what they say, that this is my valuable customers. If that comes in annual report, is a independent corroboration from outside world. And since it is difficult for the customers to migrate to other places because of the processes involved in providing that product or services, is such a complex that it requires a lot of efforts and time for stabilization if you want to move to other places, which are probably then would be an indicator that such customers will continue. Renewal expectations will be higher, even though, I repeat, the customer contract is not talking about the renewal. Need not necessarily be there. Contract should talk about the renewal. In fact, I have come across situations where the customer contract talks about the renewal, but we have ignored in renewal because the market condition, the relationship, and the kind of a product and services, unsatisfied customer, even if it is there, they are not going to just be there in the contract because there is a contractual obligation. They would like to get out of, because they can't lose their business because of your poor or inadequate or delayed or whatever. I mean, there could be a multiple reason why the customers might not be satisfied. So that analysis is very important. So what is technically called is inertia. So I call this as a inertia customer. A high value customer, a low value customer can also be an inertia customer, but typically we consider for high value because the monetary factors are critical for you to decide whether you want to move from one place to other place. So if it is a small amount, so chances would be that if there is a competitor available and that fellow can give me a better option in terms of economic benefit, so the customer can move. But a high value customer takes time, so that's how it's called inertia or the stickness. So if that is the indication at the stage when you make analysis, it is very clear that your valuation will be higher. It will have a higher element of expectational element. And if even if the contract is silent, if there is a history of renewal, so if there is a history of renewal, means it is supporting your, or history of repeat orders from the same customer, because generally customer might be going for a one master agreement and thereafter the orders are just flowing as a sub, because you can't go for each order. You can't go for an individual contract. So you might have one master agreement and then you just flow on, give an order and go ahead. So this is a pretty critical portion of that. And the second is both, we should conceptually remember that both business and consumer. So when I'm saying business and consumer means I'm talking about B2B and B2C. Both are wasting assets, and as you explained, in both situations, at some point in time, your economic benefit is going to get over. It won't remain forever. So terminal value concept, typically in a customer related intangible assets will not be there. In fact, it will it will be a limited life, and that is what is remaining useful life is. Having said that, I'm again re-emphasizing the point that if it is a B2C relationship, it will be very difficult for you to justify unless the business is such that you can claim that these are of the same developed nature what is there at B2C level. Okay. So, as we explained, the critical part of all these valuations, when you do a valuation analysis, the objective of reading contract, if it is available, or if the contract is not available, and making analysis of relationship based on your activities. Those activities would be available in terms of evidence, will be helpful for you to decide about remaining useful life. And the way you decide remaining useful life, and then of course cash flow pattern. There are two ways to address this. I'll discuss in few minutes about that. And then of course you go about if it is a contractual. So then you go about the what are those rights and duties in the contract. Sometimes the contracts will say that this cannot be transfer to assignment. So a contract which says that assignment is not possible, right? It will have a lower value. These are all negative part of that. Because it's not that if the contract does not have the assignment, it cannot be assigned. You can go and later and go for agreement. Suppose somebody buys that contract, and and you can ask for assignment, and the party can agree with the customer can agree if they can find a similar kind of a product supplier or service supplier is possible, it is there. But if there is no assignability available in the contract, it reduces the value of the contract. So I'm just giving one example there. So that's the reason why you have to read contract, have your legal people. So this requires your economist, you requires a valuation expert, legal expert, all kind of help, especially if you have a high profile case. So suppose you are doing for valuation for transfer pricing. So lots of customer contracts are sold in the international market and transferred from one entity to another entity of the same group companies, and therefore transfer pricing issues come up. So when you do evaluation, the methodology would be absolutely different as compared to what you do for fair value estimation. That is called arm's length price determination. Definition is different. Here, for fair value, definition is different. For transactional, definition can be different, and the process can also change depending upon the facts and circumstances. Also important for us to know that it's not a contractual document, but the legal rights and duties which are written in the contractual agreement is your intangible assets. If you are talking about customer contract part, renewal part without customer contract is a non-contractual element or non-contractual relationship. So a lot of time people use a variant. So they say customer contract and relationship. But sometimes you say relationship and customer contracts, depending upon what is the most important way to look for. So sometimes your now in terms of value, I'm now talking for customer contract can have current contract value can be a lower portion as compared to your renewal or expectational value. Uh, Depends upon the facts and circumstances, because your current remaining useful life, which is a legal life. Suppose it is 10 years, out of that you have already adjusted 8 years, so just 2 years is there. That portion could be very less. Expectational element, even if you assume for one more renewal, and if it is mentioned in the contract, the more the merrier, the better. If even if it is not mentioned, and then historical track record is there for a renewal happening, market condition also supports that. That's very important for you to corroborate from the market that what the conditions are. Is it okay, or is it supporting, or is not supporting? So if it is a renewal, so look at that, your expectational element of a contract value can be much higher in a situation. So how you do evaluation? Would you like to keep a separate calculation, and would you like to club them together? Depends upon your situation. So but they are part of the customer contract. There's no doubt about that. So now we're going for analysis part, and then we'll go for more methodology segments of this. Okay. Uh, as I explained earlier, can you see here the first important criteria is assignability. So can you assign the contract to somebody else? So suppose somebody gives me a valuation assignment. Can I assign this valuation assignment to somebody else? Answer is no. So there is no assignability here because the law expressly prohibits me to give this work to somebody else. It is my work. It is engagement letter is my name. So I cannot assign. I have no way to, because if I have to find out somebody else in my place, it is the service user who will choose, not it is not in my hand. But there are a lot of service contracts or product contracts where the assignability is possibility, but then of course with the concurrence of the customer. So that's the very important part when you look for valuation, because that the absence of assignability is an indicator of a lower economic value. Then the industry and profession where this relationship exists. So you have to understand the industry element of that, renewal history, specialized, differentiated goods or services, very critical. So if it is a specialized, differentiated, means that very difficult stickiness should be higher, supported by stickiness, or what we discuss about longevity of customer with the organization. So and difficulty for them to move out, to migrate, to go to somebody else. So that will be a factors. Then price elasticity of demands for goods and services. This is very important. So this will help you in your validating the top line numbers, the revenues which you are expecting, or economic benefit which you are expecting from customer contract. Frequency of purchase is also important. Growth rate in number of customers and growth rate in the customer revenue, profit margin, return of in investments which you earn from a customer, and then historical churn rate. So churn rate is a critical where we see that how many of them coming and how many of them are going. So what is your retention? So what if a company shows that my customers are churn rate is just 2-3%. So there is very marginal and very low level of a customer churn and continuing. So which means that we are getting a better uh, a situation as far as cash flow is concerned, more technically less uncertainty in the cash flow, and therefore while addressing the discount rate, it will be a better situation you can face. Then average customer life, that also important, because when you are clubbing customer, it will be very difficult in real life situations to do individual basis customer contract valuation. Are you getting my point? So if there are few customers, you can go for individual, and that too you decide depending upon if their characters are different. So if I've got 2 or 3 customers working in two different economies, even if they are high value customers, I may have to go apply separate valuation to each one, because their risk and growth expectations and other elements of cash flow will be different as compared to the other geographies. But within the same geography, or you know of a similar kind of a customer situations where you can justify it is homogeneous. So you will not go for individual level customer contract values. Rather, you classify them in a group, and those group will have a similar character. And there is what you work out something called average life. Now, the life part I'll discuss a little bit more detail. So it could be your economic life, it could be your legal life, it could be your you know historical renewal period can, I mean, that's what we call it as a expectational life. So all those factors would be analyzed, and based on the purpose of valuation, we take a call. The other important aspect are that since these are non-monetary assets, so all situations intangibles should require analysis of HAVU, that is highest and best use analysis is very important. So highest and best use analysis would also like to see your situations where will it be a standalone or it will be a part of the going concern, which way. And sometimes, of course, the standards or the regulations or the purpose would dictate. For instance, if I'm doing for 103 valuations, we are doing, component wise, we are doing for each standalone together. So I'm not doing as a business because you have already done as a business together, and then now you are doing as a standalone, that which are those components you are trying to find out. So highest and best use of intangible assets will be in the hands of the financial investor, or will it be hands of the strategic investors, will be a critical impact in terms of your valuation exercise, right? So who would be the market participants is a factor we need to consider depending upon the purpose of valuation. So for instance, you do a transfer price evaluation arm's length basis, so it is a uh, you know you basically it is very close to investment value arm's length price determination, because there is what you have to see the characteristics of the buyer, right? So if somebody having a customer contracts in USA, if it's transferring to Mauritius, so yours, even if it is your subsidiary, the only thing you have to see that the you remain in Mauritius, but it should be on arm's length what should be there. So what the methodologies are prescribed and accepted in arm's length pricing determination is that you have to take consideration of both sides, right? The seller and the buyer, both proposition has to be taken together. Typically, this is not a situations where you decide fair value kind of thing, right? So this is a very important consideration, because why it happens in arm's length determination, like uh, the tax situations in US and Mauritius is totally different, and all would know that by transferring a contract from US to Mauritius, there will be a tax erosion to US. So they would like to see that whatever is eroded, there is a tax collected in the form of a transfer pricing. So both buyer and seller considerations are important there. Whereas in fair value estimation, you are looking at the market participants, where you can sell them. So will you be in a position to sell that kind of a even if suppose the owner of that intangible asset is some other country, but where that asset is lying and can be exploited, that geography will be important for you to develop cash flow, develop discount rate, select discount rate, and then do a valuation for that. Okay, so one more important concept which will come up is called contributory assets. Okay, so this is a pretty simple concept. As he explained, no intangible assets, including your customer related intangible assets, can in isolation generate cash flow. So you require some other support in the form of land, building, plant, machinery, employees. Okay, that's how we assembled workforce, trademark, patent, all those things can come up and together can generate cash flow. So this identification, we'll discuss more detail about contributory asset in few minutes. Identification of which are the assets which are helping, that is how they are called contributory assets, or contributing in generation of revenue is very important. So unless we reach at that level, and if you are in identification or uh, your there is an incorrect way of assessing economic rent on those assets which are needed together to generate revenue, your valuation can go wrong. Okay, so contributory assets identification, contributory assets valuation, and charges on contributory assets, that is called in a layman's sense as economic rent, and you can call it as a more technically as a charge on contributory assets. Okay, so identifying appropriate economic rent on all those contributory assets would be important, because when we go and try to roll a method, an income approach, our objective would be to, you know, even if I'm owner of such assets, but I'll assume that if these are rented, what will be the economic rent I'm going to pay for that? And after that, my job is to get whatever residual remains. That's how we'll see later on will be called excess. Excess earnings will be attributed to customer related intangible assets. Okay. There's also a very important point that at customer relationship can be more profitable than your average profitability of a company. Okay, that depends upon if you are dealing with so many other products and services. So one component of a relationship can have a different operating profit. So I've seen people making error by taking the company average profitability to do a valuation of a customer relationship. Would be fine if you have uh, you know, only one kind of a customer, then there is no problem. But if you have a even the similar product and services, there can be, because of your relationship, the operating margin for each customer can vary. And that's what I explained, that it is important to have data at customer level to understand the profitability, and allocation aspects will be very critical. So most of the situations, average or reported profit or accounting EBITDA or operating profit may not be very relevant one in doing a customer relationship evaluation. It has to go on a customer level. Okay, and depending upon the purpose, you have to decide that what is more normalized numbers which are available, not one just reported in 3 months, 6 months, something like that. So this is a little bit as support for you about one of the most important critical component is uh, deciding about should there be a terminal value or not. So answer generally is no, no terminal value. And what could be a revenue useful life estimation factors before us? Economic life can be more than your functional life, right? Or legal life sometimes it or statutory life, it can be more than that, or it can be less than that, depending on your facts and circumstances. The technological life also the one of the consideration if your customers are in kind of a technology related products or services, because you have there is a obsolescence or technological obsolescence, which effectively means your customer will run away. So the technological obsolescence can restrict the life. Legal life can restrict and economic life can be even lower than the technological life. Sometimes we are bound by some actuarial life. So actuarial life is when we are using various sort of curves and details in case of a if I'm unable to find out customer relationship based on plain analysis. So I'll show you some way of looking. So there are multiple factors which I need to consider before I conclude. As I said, very difficult proposition. In share valuation, you understand that everything goes in perpetuity, except in some circumstances it may not be. Here it is a big exercise in terms of your these are not the one which I've listed here is the final one, but this is something which is very important. In some situations, like in transfer pricing, I might be only restricting on the legal life, but I've seen transfer pricing authority challenging also for the expectational portion of that. So there is, varying judgments, varying proposition. We have to see it very carefully, that which geography you are doing and what are the legal positions settled there. Based on that, you can go for. Okay. So here you can see that contract life is 5 years. Just one example. Remaining contract life is 2 years. So legal life is just two less, right? But your analysis, based on historical records and renewals and relationship with the market, industry, etc., says that two renewal of 5 year each is possible. So in this case, your remaining useful life will be 2 plus 5 plus 5. Okay. So it will be 12 years of remaining useful life. It will be quite possible that the first 2 year will have a different discount rate. The next 5 year will have a different discount rate. The last 5 year will be the most uncertain out of these elements of the cash flow. So it can have a different discount rate. Okay. And based on that, you do a valuation for. So this is the one example. The next question says that, do you think that the RUL, that is remaining useful life, will change based on the purpose? Answer is yes. It is quite possible in some geography that transfer pricing purposes, remaining useful life will be just 2 years. And you can fight for that expectational element is not covered there. I'm only transferring, but in some geography, expectational elements are a part and parcel. So you have to read in detail the past precedents, legal judgment. That's what I say. Involving legal people is important before you form opinion. It's not pure valuer's domain. You need to be supported. So you might not be an expert in that area, so you can take help of that other people, right? Now, how you then project the relation? Suppose you now know remaining useful life. So which way you go and find out? So one is that you take the average RUL calculation if it is possible. In some cases, it might not be possible. So when you find out, you can also by a diagram, you can cover full without any decay. You will not take any decay in customer relationship, because as you said, these are wasting asset, means over a period there will be a decay. That is called a customer attrition. So there is a mechanism to compute that. Either you do that way or you calculate a decay over a period. So economic benefit, decay, life, customer. So a lot of time, the valuers who have seen this one component that, or looks more soothing to eyes for people who have no background in valuation. So they feel that this one is better, because I will be able to see what is going on, right? Here I'll be capturing everything in an average basis without any decay. If it is settled properly, okay, settled properly means that if it is adjusted in terms of discount rate, etc., and a growth rate in a proper manner, it will not matter whether you have gone for first method or second method. The result should be close to each other. Okay, where you go wrong is if you have not properly adjusted growth and not properly calculated the average remaining life. So that is what you can make error. So you can see here, one is demonstrated by a graph. The first alternative is what I'm talking about. So you can see here, average age of relationship is 5, expected life of new client and average age of new client is 15 years. So I'm just covering for first 5 year, okay, and then taking the full 100%, no decay here. So that's the one way of looking. Or I can go for a longer period with a decay. So it's one of the same thing, two way to do that. Can you see that here? Now I'm going for 15 year. This is the expected life, so this is ignored. What you take is the average age, not the expected, and this is 15. So either you have a choice to go for full 55 year, or you can go for 15 years. So I'm going for 15 years in a decay manner. This looks very soothing and appealing to auditors or reviewer, because they believe that since it is a vesting asset, at some point in time, how long you can go in future is about uh, till it remains in that 5% range. That's how, it becomes negligible in a sense. So you can also put a decay rate, and at this is false. So will it be a constant? Will it be a how it will be determined is something which we'll discuss later on. But these are the two possible way of getting your counting process starts. So now let's see discuss about quickly the methodology now, because I just want to give you time for some questions answer also. And so let's first start with the customer list portion. So customer list valuation is typically on market approach basis. Be careful that it not should not be legally prohibited to do transactions. If that be the case, then there's no value. Everything which you pay goes as a part of. Would you still need to pay to be paid for at the stage of acquisition? Answer to be there. Customer database, typically can be done based on cost basis, or it can also be done on if there is a expectational element involved into this. So you can do into a using a cash flow method. And customer contract relationship mostly would be done by income approach, and these are the two methods. MPIM is basically is a variant of discounted cash flow method, and distributor method is a variant of MPIM. So again, find this more some fraction portion of MP covers. I'll discuss when we'll use distributor method, when we'll use MPIM. So some focus on now on MPIM. MPIM is a multi-period excess earning method. So this double E is very important. So double E means excess earning. Now what excess earning is? An earning which you can attribute to particular customer related intangible asset. How do we do that? I'll show you. And why the word multi-period? That means it is more than one period. Okay, so it can run. You've seen that 5 year, 10 years. So these are some. So there are a lot of benchmark reporting also available in practice now. Not in India, but in US it is available. You can take an idea about that. And what is the average? I repeat, the word average and expected life are two different things. So it is the average depending upon how you are moving and you are trying to capture in a decay manner. So you need to find out the decay rate. If you are trying to capture the full and just forget about everything else, that would not require a understanding of decay. So what do we do to roll multi-period excess earning method? The first step is to find here the PFI is a prospective financial information that we call as a projections. Okay. So first you have to do for entity level projections. So when I say entity level means for the entire organizations which owns the subject intangible assets. So in valuation, you all know that subject intangible asset when we say means the one which we are valuing, right? So you why it is done at a step one level is very simple. It will be very difficult to do a valuation uh, at a group level. Sorry, projection as a group level, unless the industry or the company data supports you to do that. So you just get out of the step one and then start with the step two. That's what our objective is. But in most of the situations, you will start with the entity level, which is you have the historical data, you have the market level situations, so more validation or corroborative evidence available for you to support. So first validate number at entity level. Okay. Once you have done that, remember our objective is to start with the entity level. Okay. And then we'll view the processes one by one. So we start with the entity level, and out of this, you go gradually, one by one. You do in a manner so that at the end, whatever remains, so whichever assets are needed for generating cash flow, right? they need to be charged in terms of economic rent because they are being used as if you have rented them, right? So when when you run a business, so you have an operating cost, right? So you pay taxes to the government, and then you also have some your internal other assets which you needed, and then you remove them, and then accordingly, finally you reach to a number which would be a residual, and that's what is called excess earning. I also repeat, this excess earning name sometimes could be misleading. It's not earning, it's a cash flow. But why it is there? Because traditionally, when it was developed, this method, since then, it is being called. In fact, in US, it was developed for by their IRS to assess tax issues, and as a result, this MPM name still is pretty uh, very common to be used. But ultimately, it's not earning; it is a cash flow. So there should not be any confusion. So you will start with first finding out what is my overall projections of an entity. Much easier. Do a validation. Stop. After that, now you find it is quite possible that your customer contract sits in for the everything, and therefore you don't require a separate further step two. But in most of the situations, it is quite possible that within an entity, a subset of asset, or more easier way of expressing would be to say a group of asset, okay, and that group must include the subject intangible asset, which means the customer contract or customer relationship, okay. So you have to first identify group of asset where your subject intangible asset sits in, and those group of assets other than the subject intangible assets, that means within the group of assets, suppose there are 6 assets you have identified: working capital, fixed assets, right, all those kind of things you identified, other intangible assets together. So if there are 6 within the group and one is the subject intangible assets, all together generate the revenue. So 5 would be called contributory assets. I hope that's clear to you. Out of 6, 5 would be called contributory assets because they are helping. So in all 5, you will be charging economic rent. Okay. Now the economic rent calculation is also little bit complicated. So which I'll discuss because this goes on, and then the process, of course, is a pretty lengthy topic, but still I'm trying to simplify. So first I uh, estimate or phrase my projections at entity level. Then I carve out my projections out of the total to that group. So what can be attributed to that particular group? So what will be their revenue, what will be their cost, etc. I can then allocate. Sometimes this allocation process will be easier, and sometimes this allocation process will be complicated. I repeat, if you are able to identify the group in advance, okay, and there is directly projections is possible based on availability of a data and also for validation purposes, then you might not require step one at all. Straightway start with a finding a PFI of the group of asset where your intangible asset is one of the assets and all other assets should be called as a contributory assets. Okay, so you identify this, then next step, third step is, so one or two are variable steps. I mean, in some cases you require both for step one, step two. In some cases, only step two will become step one. After that, your objective is, as I said now. So first I have data of entity level, then I've gone to a group level where my intangible assets sets in. Once that comes in, now I am trying to find out how much I can allocate to the subject intangible asset as cash flow. Okay, that's my next job. So for that purpose, you know, you have to come back to any earnings that are attributable to the contributory assets. Okay, so you have to first kick out the earnings which you can attribute to contributory assets. We now know what contributory assets are. These are assets forming part of the group, okay, other than the subject intangible assets. So what earnings they can have it? Those are called return on. Can you see in red? Return on and return off. So I'll discuss this a little bit uh, after this slide, and it's a very important concept. But for the time being, sometimes if somebody is pretty new to this topic, gets confused what this happening now. So these earnings are defined and also called CAC in a contributory asset charge. You can see that the CAC is not nothing but an economic rent, right? So we are presuming that this trademark is not mine; it is being used in the business. So how much I pay rent for? If I'm using patents, so how much I pay rent for? If I'm using a software, how much I pay rent for? If I'm using working capital, how much I pay rent for? That's how the CACs are. But there are two way of finding contributory asset charges. One in the form of return on, another in the form of return off. Okay. So return on is basically nothing but is like a normal investment which you make and you try to earn a return. So if I make an investment in any financial product or somewhere else, say a fixed deposit and you earn 10%, you call this as a return on my investment. So that's the return on it. So all assets will have a return on. Now, the return off is basically a recoup. So recoup, I mean general concept, then we'll go more detail. Recoup means uh, while running business, your asset also will adjust. So it could be tangible, it could be any other assets, right? So you have to be careful. And a lot of people make in terms of intangibles, a lot of errors. Okay. So general concept is that where there is a adjusting nature of assets, so in that case, you also require something called return off because your asset is depreciating. So you first got a return on and then you are now calculating return off. In fact, combined together, these two assets, if I combine together in present value terms, should be equal to my fair value of asset. So sometimes if you have a confusion, you can always go and test it that whether you have done a right calculation or not. So simple example could be about the return of say PPE element except land, which is a not an adjusting asset. All other assets are existing, so therefore there will be a return off in addition to return on. Can we say the same thing for the working capital? No, because you will recoup the entire working capital at the end of the project. So there is no question of going for return off on working capital. You will only count return on, right? So that's the simpler concept which you will see that in terms of economic rent. So what we have done so far, you calculated the economic profit, and from there you kicked out economic rent for contributory assets, the assets which are helping you to generate the cash flow. What you get is a excess charge, excess earning. Now this excess earning is a cash flow, okay, and that is technically is nothing but the one which you finally got as a residual figure, which we are saying this must be attributable now to the subject in interest subject intangible assets, which is the customer contract. Okay, then you get a present value of that stock. After that, you also require a concept called tab, which I have not shown here. Tab is a tax amortization benefit because these customer contracts in some geography, including India, you have tax deduction available, right? So when you have that, that tax amortization benefit. So buyer will get if buyer pays amount here, then he will get a tax amortization benefit also. Since it is an income approach, so tax amortization benefit also need to be counted together to get a fair value of this. Always remember now it is settled if you are using any market approach. So you don't require a tax amortization benefit if you are using cost approach and using data before tax basis, then you don't require a tax amortization benefit. Okay. So These are some examples of contributory assets. Can you see that? These are some examples of contributory assets like working capital, fixed asset. These are and you can see the sample workforce, which I'll show you. This is how you work out cash flow. So I've just started with EBITDA. You can start with, from the top, that is revenue, and then OPEX, then come to the EBITDA to make things simpler. So you start with this. I said this EBITDA may not be, I repeat, equivalent to your overall reported EBITDA for the company level. Customer wise, it can vary, and for customer relationship or contract can be different. So then there is a very obvious reason of selection of tax depreciation, because that is what you get tax advantages. You get EBIT, then you taxes, then you get something called debt-free net income, or also called NOPAT, net operating profit after tax. You add back depreciation. Can you see that? So we are going for a cash. So up to this is a cash flow which is available to the entire group, and we have discussed that in our entire group we have contributory assets and the subject intangible asset. So therefore, if I can remove or scrub the earnings available to contributory assets, I'll be able to get the cash flow which I can attribute to the intangible asset. That's the whole concept is. So you go and calculate return off, right, and return on. So these are some examples given. When I say return on average balance of fixed asset, doesn't mean only on fixed asset. So all contributory assets. Okay. So typically return on is on everywhere. Return off is available depending upon what kind of asset we are talking about. The basic idea is if it is exhausting nature of asset like a PP other than the land, they will have the economic return of calculation. On and off together should be giving me the fair value of an asset. And if it is not, that means we are either you are overcharging or undercharging, depending upon that. So when you do so, this is called uh, uh, economic rent. Here I have given that other than fixed asset you have, then you also charge CAC. So contributory asset charge you knock out. So this becomes your cash flow. You take a present value and then of course make adjustment for tab also. Now this is what your return off is there. One is for your economic of current fixed asset. So make sure that if your projections is having a growth projections which requires a additional capex, which means you have to add further for those existing asset in addition to the current fixed asset available as the valuation date. So this error should not be there. Return on is simple and should always be calculated on after tax basis, and this is about your normal return, which the way you calculate. So if you've done PPA, there is what we calculate return all on an after tax basis are there to tally that. That's what the return on is. It's like if you make investment, what is the return you expect is the return on. Okay. And should be calculated on average basis. Why? Because if you calculate on closing or opening, so it will be lopsided. Sometimes the data can be pretty misleading. So average is better. So these are some important point. I just touch upon something quick because we still have a few minutes left, and I just want to give you also time, and we also have to run AWF. So, but some of them will be important that a CAC is not required when contribution of contributory asset can be separated. So suppose the basic condition is that if for something which you already charged, okay, already charged in operating expenses, so make sure that then you are not separately calculating a CAC on this. So you have to check your operating expenses which has gone into that. Otherwise, it will be a double counting. Similarly, always the contributory asset should be on a normalized level. So in some companies, you will find that the working capital investments and others at some particular day will be very unbalanced. So you need to normalize, because otherwise that will not be appropriate situations for application of capping. Okay. CAC application, typically you do it on and off on entity level. That's how I say if your projections is at entity level, it becomes much easier because again, you have to do projections to calculate this and then you allocate that. Suppose if I've got 100 rupees for the entity, so how much I can allocate to my group of assets. So that depends upon how much revenue is there in the group and then you can allocate there. Uh, as I explained, there cannot be any return off on working capital. Similarly, return on and off both would be needed in case of PPE, except land portion. If you have a land portion, this is very important. And also remember, a lot of companies will have a non-operating assets. You just take out them. Don't charge any CAC on non-operating asset. That will be incorrect because those are not being used. So you are only using the one which is used in the operation. So for instance, something which is classified as investment property is not a subject matter of a CAC. So PP here also it should be fair value, but typically you will see that whether it is already reported at fair value, then there is no problem. Uh, I see a lot of situations where the land is, if it is a book value, is not restated long for the fair value, and there is a huge gap between the book value and the fair value. Then you need to restate your land figure for application of a CAC. Okay. Should I apply CAC on AWF? Answer is yes. Should I apply the same thing for the goodwill? Typically, the answer is no. It's very, very rare situations will be considering any CAC on goodwill. So that's not practice. So this is what I'm saying. Typically for working capital and most of the PP, you can go for book value. Make sure that when you are doing so, you are very clear that book value and fair value is not excessively different. Some situations your excess earning for a particular year can be negative. That's possible, and or if it is a negative value in aggregate due to application of CAC, if it is happening, which means there is no value in the form of a customer intangible asset. So you just reject. So sometimes you also do this exercise to reject that there is no value for customer relationship based on the facts of the company, right? Any negative value of excess earning in a year should not be disregarded. It should be counted. A negative value after sanity test is still there. That is indicates there is no economic basis. This is very important. So after consideration of present value, where the negative is there, and still you get a negative value, that means there is no economic basis for that contract to be recognized. So I'll just show you here. This is the one way of calculating remaining useful life, right? The first box you saw, uh, where you can calculate 100%, no decay. So decay basis analysis is needed. So you just have to do -1 divided by natural log or percentage of revenue retained. So if you have a attrition rate available, you get analysis of that, or churn rate available. You can calculate remaining useful life for homogeneous customer. I repeat, if a customer is not homogeneous, you can't apply this concept. Then you have to go for a some situations you may have to go for a statistical curves rather than doing this. Okay, so this part I just miss out. You can see here, existing customers revenue attributable to existing customer. This is 3 years data. This is revenue to the existing customers. This is the annual growth. That's how is you calculate some demonstration of how do we calculate excess earning. So it's like a cash flow, same process, which we discuss. Now here, this is a one way of looking attrition analysis, which you saw in my formula of RUL divided by 1 minus what you retain. So for that you require attrition. So this is what we call as a vintage period. That means I'm starting time -5. Okay, so I'm starting from time 5. I have got 10 customer, 5, 4, 3, 2, 1. I come back till my valuation date. So you can see some of them are retaining, some of them are going. These are the cash flows available. So I have got two way to calculate attrition. One is aggregated, another is a disaggregated method. Okay, so this is the total 20 customers each year data captured, and what I pick is how many customers are there in year 5, and out of that how many of them are today, and what is my cash flows from them. So this is aggregated method, means you calculate together, so just everything else, what is my cash flow, and then you calculate attrition, and you can see here I've calculated geometric average of 12%, so I'll be knocking down 12% each year. Okay, you can also do this same exercise. That's how the projections are. You can see here the current annual revenue after knocking down. I can do it at disaggregated level also. It depends upon what you are doing. This is one example of how you apply CAC on working capital data. So if you have got 3 years projections time zero working capital, can you see that? Then you have a uh, incremental working capital. So this is the closing, and then you take average, and then suppose you decided 10%. To give an example for working capital, there are a lot of confusion about what should be the appropriate. In fact, I personally see a lot of time auditors fighting because you just read one component of some textbooks. The correct way of assessing this is not always after tax cost of debt. I repeat, there's a best practices suggested by again the appraisal foundation, because we all know in practice working capital, can it be financed 100% in India? Answer is allowed long back. There is no nothing called maximum permissible bank finance, but still bank uses maximum permissible bank finance. It has been withdrawn, which effectively means there is some component of the working capital requirement which is to be pumped in by the entity, and some component, maybe 75-25, will be pumped up, or 80-20 will be uh, uh, pumped up by the bank. Whether there is any restrictions for a bank to go for 100% financing, answer is no. So if a company or if a market participants can finance depending upon a particular kind of a business 100%, so I have no doubt about that case. It should be after tax cost of debt as my return on working capital. But if it is a mix of that, so then it should be WACC, right? But this WACC should not be the WACC of the company. The weight here would be different. The weight for the WACC for the company is different than the weight for working capital, which means if you are pumping in cost equity component along with the debt, so that weight should go, and then that is the most appropriate charge on working capital. So which people need to appreciate and understand. So now I'm in the final session and of assemble workflow before I take questions. So we are nearing to that. This is one of the easiest one for you to comprehend. And I did explain how much I'm going to value uh, for an asset which I cannot control. So employee I'm not able to control. So I only say in this free market situation that how much I need to incur if I have to replace that employee. Okay. So if suppose there is somebody MD and general manager or low level employees, so what will be my cost for replacing them? That becomes my value if I take, because if I have to buy everything except the existing trained employee. In fact, some cases this value will be pretty high because the organization will be driven by the employees only. In some cases, it will be low, depending upon the facts. But the process and the methodology remains same. I also repeat here that all data which you will take here, you must take on pre-tax basis, because there are some textbooks, and these are the old edition and international basis. They still say that you can take after-tax basis and make adjustment for tax, which is what not the practice now. The tab adjustment is now only allowed, and which is rightly so in case of income approach, because the buyer after getting that will get amortization. In market approach, it is already factored. And here, if you take on pre-tax basis, there is no question of further adjustment on account of tax. So principles are very simple. How much I'll incur if I have to do a valuation of assemble workforce, that will be what will be my direct or indirect cost in terms of hiring, training, recruitment. I'll also explain about that, and then those replacement, that means if I know the replacement cost of my employee, and then I'll count something called developer profit, because whenever you do this exercise there should be some profit element involved, and then at the end you add something called entrepreneur incentive, which is the earning which will be expected in your investment part, and all together will be your fair value of replacement. So I'll just roll through of a small set of data so that you can understand how it can be applied. Once you collected employee data in a various group wise in each company, you can't go and compute this on individual level. You just club them together, right, to make things simpler, because ultimately it's an estimate. Can't go. I mean, of course, if you have a data in one to roll Excel, I'm not stopping. So suppose we have got three levels of employees, and these are the numbers 100, 200, something. These are their average salary. These are some additional thing which are paid to the employees in addition to their average salary. So these are called other factors. So all attached with the employee benefit. If you have got one data itself, so you don't require this fourth number adjustment. So these are just so the salary, finally, the full absorption cost means total employee benefit here you can see is in the first category is 3,70,000 and 60,000. Okay. Once you know this salaries, appreciate that we are not doing a valuation of a human capital. That's different exercise. We are doing a valuation for replacement cost of those. That's only the assembled workforce. Is this some component? That's all. Because if I don't get, I'll have to hire them from the market. After that, the next step is to find out the cost of recruitment, hiring, and training. Okay. So this is a rough estimate. In each case, situation difference. I'll also explain you difference between hiring and recruitment. In some cases, it can be clubbed together. Hiring is about filling up a identified open job, right? Immediately, there is what you hire. Recruitment, that hiring might not result in a good hire, right? Recruitment is a continuous process of identifying the best possible employees. So sometimes you go earn, right? So your recruitment cost happens all over the year, right? It goes to various campuses, moves across that. You just hire few of them. So hiring recruitment costs, if the data available separately, can be clubbed together, or you can have it in one in separate. You can also see that recruitment cost for the top employee will be higher and the lower level employee will be lower. So that is what you can just shown by examples. And then these are the some training cost, also the same proportion because they need to be trained properly. So roughly you can see here recruitment hire training cost is 80% and 50% of their full absorption cost. So what was that full absorption cost? The first employee 3,70,000, 60,000. So can you see it here? 80% of that is 2,40,000. So I got per employee average workforce replacement cost, which means that what I'm trying to say, if I have to, as on valuation date, if I have to take them on from the market, okay, these are the costs which I'm going to incur per employee basis in terms of their three components, right? Recruitment, hiring, and training. Okay. Once you know, then you have total number of employees. So can you see here when I'm doing now valuation? So I just multiplied 100 there, 100 here, and 100. So all these three, if I add together, it will call direct and indirect cost, which is here 358 lakhs, right? After that, you need to understand that in that particular industry, what is the typical profit people want to make if this is the kind of expenses which you are going to incur, that is a developer profit. Now here is a catch. Most of the authors, I think, except few, which are top class authors, the people apply 10% directly here, which is conceptually incorrect. The 10% should not be applied directly here because this is a profit, which you earn after the total cost. So therefore, it should be 358 lakhs 10% of that, divide by 1 minus 10%. So this figure is, is a reverse calculation. So one correction in the industry practice I'm doing here. Then entrepreneur incentive. So for that, you need to find out how many month you require or year you require to replace the entire batch which you have got right now. So in some cases, it could be very large and takes very time consuming. That's the average basis calculation. So and then you calculate the average cost. So where it'll go? Here, not on this. There will be no incentive calculated on profit. The incentive will be calculated on your cost. That's the routine return on. Okay, this is a return on. So this is average means you have not incurred in one day, so you can't ask for the entire 358 crores. So average is the solution for that. So 179 lakhs is the average. And then suppose your return on investment, which we saw there, is 12%. So 6-month calculation is this. So if you add all three components, it together is a fair value of your assembly work. So that's what from my side. I think if you have a questions, so probably now I should open for you.
Thank you so much.
Can you now take out this presentation from here? Stop sharing.
Yes, sir. You can definitely stop sharing.
Yeah. So you have a question, so you can.
Yes, sir. There are a lot of questions. Thank you so much for an insightful session. So we're starting with the first question. Can the banks have intangible assets in their balance sheet by valuing customer relationship?
If the bank is acquiring another bank, okay, and if they are applying PPA, they can have it. But per se, as you know, no intangible asset will go on financial statement unless it is paid for, okay, except some software and etc.
Thank you so much, sir.
I think
The
this
next-
question appears to be from IDBI Bank. Am I right? Okay. So they have asked a tender document where they said identify my all intangible assets. Oh, so they will have a huge intangible asset, no doubt about that.
So next question is, how can perpetual movie rights be valued if purchasing for broadcasting over television channels and OTT? Also, if after depreciating over a certain number of years, what methodology to adopt for evaluation?
No, you have to repeat the question because I didn't hear properly the first component. Can you just repeat?
Yes, sir. How can perpetual movie right be valued if purchasing for broadcasting over television channel and OTT? Also, should I repeat the whole question?
No, first one is fine. Yes. So let me first answer, then you can repeat the next one. Okay. So two loaded questions. So see, this one is what you are talking about, the contracts. So this is a licensing contract, right? So licensing contract also is valued based on the expected cash flow. Problem is that there are certain kind of industry like a movie industry and etc. Forecasting cash flow is a pretty difficult exercise, right? So you have to take into account at some point of time, even the movie which you fail that has failed, and something happens. It's a pretty funny thing in a corporate world. If a company declines, it declines, right? It goes out of the picture, and there is no chance it's going to come. In a movie and film and any kind of these situations, what will happen? Suppose something happens to the actor. I suppose he dies, right? And so suddenly you see a kind of emotional burst will come, and then everybody will start downloading song and cash flow. So it's like coming like a phoenix. It's just your turnover is here and now it will just shoot up. So this is a very variable kind of situations which you will encounter in case of films and etc. But there are a lot of database to support in today's world, as we know, in a digital factor. So based on that we can forecast in cash flow. Licensing, all agreements are done in valuation on either on greenfield method or based on a cash flow. No way you can or yes, it is a broadcasting rights and etc. So if you have a transactions available, you can compare it. It's possibility. So market approach is there. What was the next? What was the part question attached with the second one?
Yes, yes. Next part of the same question is also, if after depreciating over a certain number of years, what methodology to adopt for evaluation?
Oh, that's again is a wonderful question. So what he said that the first day you did evaluation, okay, and after that you started for amortization, and then what should I do next? So it can impair, okay, it can have more value also, depending upon how the market has gone, what is your economic benefit potential has come. So suppose you got a license at that time, business opportunity was very less. Now, because of the change in economic environment, like if somebody asks you that movies and etc. in 2020 and 2021, it have been a disaster. But now look at that. Everybody is watching a movie they should not watch, isn't it? They are watching Janwar, they are watching all kind of movies, which, which, and of course, they have a lot of money to spend, So the data which is coming from the market is unbelievable. In UK territory, the full house going in a film like Janwar. So who's watching that? And £10, £5, you're paying for a movie which you should not be. I mean, I'm not recommend you should not. You must watch if you wish. But for an analyst perspective, what I'm saying is that your valuation remains same, principles remain same. Only thing you have to look for what change has taken place the day you recognize and the day you want to review that. Okay, in terms of cash flow.
Moving forward with the next question, sir. How
Yeah, please.
business valuation
Hmm.
how business valuation differs in maximum rental outlets on metro cities, where high value customer concentrated is valued against online companies which
Hmm.
do not have much offline existence but large customer base. For example, Reliance Smart Bazaar versus Amazon.
Hmm. So again, I'm coming back to that. That's a very good question. I think somehow I've addressed when we were discussing. You have to find out the customers, whether they are B2B customer, whether a B2C customer. So even though they are, the confusion for a layman is that, oh my God, these are my customers, and I have the database, so therefore there is a value. I'm not disagreeing that. If you have the database, when the transaction happens, it will be paid for. But most of them will go as a part of the goodwill, that will not be a separately recognized intangible asset there, right? But if you are dealing with a situations where suppose you have a customers who is in a B2B basis, if you are doing a transactions or if you have a customers which is developed over a period, so you have a valuation there, right? So Amazon having a large B2C customer, Amazon has both way, B2B and B2C, right? So if Amazon has a B2C, that component will not go there as a identifier. But if it has a B2B, it will be, because Amazon also sells their own brand, isn't it? And have their own supplier, own buyers, on a large bulk basis. They have their retail business who they buy product from them and then sell also. So you have to, bucket it, that which one will be identified, which one will go.
Thank you, sir. Moving forward, for startups, which is the valuation method accepted for audit?
Startup. So a startup issue I was discussing yesterday in NRC program anyway. So if your question is no, but the topic, do you have time so that I can explain? Uh, First is startup, you're saying, okay. So important thing for you to know that even for a company, this is very funny though, for those people who are looking only compliance part, they are only looking what is the valuer's figure given. In fact, the figure which you want valuer gives you. And I'm sorry to say that as the fact is, and then you sign it. Okay. Now the question is that if it is a startup just started, you have to first look at it, what the company has. That's very important. Okay. If the company, most of them will not have a serious amount of intangible asset to start with, except some few situations. Okay. If it is started by a promoter who have that kind of a pocket to adjust for that, so most of the situations will find that intangible assets are critical. So if a startup initial stage doesn't have the intangible assets, so you don't have patent, you don't have trademark, no, you are not a technology company. There's nothing to exhibit. So what value can be I ascribing to your company? You roll DCF as much you want, but what I'm paying for? This is ridiculous. I've seen people doing 200, 150, 300 crore valuation where the company on the balance sheet, you just think reverse manner. If I have to buy this company today and apply PPA, what will happen to that? The tangible asset are negligible. That means I'm paying entirely for the intangible, and then have a microscope in my hand trying to find out which intangible I paid for. So finally, the only one name comes in my mind is called goodwill. I get my point. So if that is the case, then thank you very much. So that I will still agree, if you have a talented employee, if you have a technology guy who can create something, I'm not still denying. The important part is that initial stage, please remember, I gave example yesterday in an RC seminar also. In a startup, in any company though, but in a startup, it is more permanent, more prominent. Is one is called jockey, who is the rider of a horse. Another is called the horse, right? So horse is your business, and jockey is the management, right? The founder. So in a startup, it is the jockey which is valued more. The horse which goes down, right? So there sometimes you won't be able to see where the business is. Whatever money you are pumping on the individual. That is skill set of the individual, the ability to roll, ability to raise fund, all those factors need to come in. Having said that, one is the transactional purpose, that means to decide the price. Another is a professional valuation. When you do a professional valuation, means you're doing for compliance, boss, you will still have to find out and apply your valuation standard. In fact, last month I was in Mumbai, and an IBSC technical director, I asked a very pointed question that this standard is not applicable for a startup valuation. So in most of the cases, those who are saying I'm applying IBS, I mean, most of them will be grilled and will have no answer to. In fact, no standard is there. So you have to have a separate chapter, because the dynamics is different. The market participants are totally different. The one who buys shares in a market, they never go and invest in a startup. Am I right? They're the risk taker individual. So their expectation, and you are calculating, say, cost of capital as if it is a listed company. So you're not addressing risk. Not all startups will have a same level of risk, which we generally feel that all will have a higher risk is not correct. Some startup will have a very low level of risk. So identify, is there startup generating revenue? Is there startup generating profit? That's one of the best possible situation in the first year. If the startup is not generating revenue, not done anything, cannot be identified any kind of intangible asset, so you just roll cost approach. That's all. What should I pay for? Tell me, even that cost approach will be higher at some point in time. That would be only for saving if I'm interested in, incorporating a company. So I've got an incorporated company. I'll also make sure that I do a due diligence properly, so that it is properly funded company, rather than otherwise tomorrow you're facing a money laundering case against me. Are you getting my point? So you have to take into account a multiple factor. The question is, can I apply cash flows also? Answer is yes, if there are a comparable company, if you make an efforts. But typically, if it is, as I gave an example, if those indicators are not there, then I think cost approach should be a wonderful thing to do for just a baby company, paper company. I call this. There's nothing. Just you frame the company. It's like a trademark you register. So suppose I got a name registered that tomorrow I'm looking at Janwar, then I'll say that Janwar Plus. Okay, I won't get it because there is a Janwar, but but if it is Janwar Plus, if suppose is there, but can I go and say that give me 100 crore rupees? Nobody is going to give. Are you getting my point? Because that requires a monetization effort. You require an actor, you require a director, you require an expense to add. So all those aspects need to be covered. I
Thank
hope
you
you
so much,
understand.
sir.
Yeah.
Yes, sir. Thank you so much. You've very well explained the concept and answered all the questions. Since we have extended the time limit, I cannot ask all the questions. So we will have to end the session here. As we conclude this session, we extend a sincere thanks to our distinguished speaker, CA Rajiv Singh ji, for his valuable insights. We also express our gratitude to our chairman, CA Hansraj Chok sir, our Vice Chairperson, CA Preeti Paras Savla ma'am, and the entire support team of ICAI for initiating and supporting this platform for the field of valuation and guiding us. Last but not the least, we would also acknowledge and appreciate our audience for dedicating your valuable time and for your active participation. Thank you so much. We are eager to meet you again in our upcoming sessions. Till then, I hope you keep learning and keep becoming an expert in the field of valuation. Thank you and wish you a Merry Christmas and a Happy New Year. Have a wonderful day. Thank you.
Thank you, Shruti. Thank you all people who are hooked to the program for 2 hours. And then happy Christmas to all of you. Merry Christmas. Thank you.
Thank you.